In January 2021, a seismic event rocked Wall Street. A short squeeze of GameStop stock surged to unprecedented heights. What began as a niche online discussion soon turned into a financial frenzy that left investors and regulators scrambling. How could a single subreddit ignite such a market upheaval? The answer lies in the convergence of massive short interest and coordinated buying power. As the numbers rose, the world watched, wondering what would happen next. The foundation of the squeeze was staggering. Roughly 140% of GameStop's public float had been sold short, a level rarely seen in modern markets. This extreme short interest set the stage for a dramatic reversal when buyers pushed the price upward. With more shares borrowed than actually existed, the potential for a squeeze was baked into the system, priming the market for a spectacular clash. Could this imbalance alone trigger the chaos that followed? The catalyst arrived from an unexpected source. Users of the Reddit community /Wall Street Bets. These retail investors, gathering in a digital forum, began buying shares and call options en masse, deliberately targeting heavily shorted stocks. Their coordinated actions turned a speculative idea into a market-moving force, demonstrating the power of online collective behavior. How did this online crowd manage to mobilize enough capital to challenge institutional players? By January 27, the surge was undeniable. The stock price had risen 1,500% over 2 weeks, and the subreddit logged 73 million page views in a single day. Such traffic reflected a massive influx of new participants, many of them young teenagers eager to join the rally. This explosive growth amplified buying pressure, pushing the price toward unprecedented levels. What would the market do when the price breached the $500 mark? The climax arrived on January 28, when GameStop's pre-market price surged past $500 per share, reaching an intraday high of $483. Over 1 million shares, worth $359 million, were marked as failed to deliver, and the company's market capitalization peaked at $33.7 billion. This meteoric rise stunned analysts and prompted a flurry of media coverage. Yet, as the price skyrocketed, what would the trading platforms do in response? Almost instantly, several app-based brokerages, most notably Robinhood, halted buying of GameStop and other volatile securities. This abrupt restriction ignited fury among retail traders, who accused the platforms of siding with hedge funds. The halt sparked a wave of class action lawsuits filed against Robinhood in U.S. courts. How would regulators and lawmakers react to this unprecedented market disruption? The controversy quickly entered the halls of Congress, where the U.S. House Committee on Financial Services convened a hearing to examine the incident. Lawmakers questioned executives from Robinhood, brokerage firms, and market makers about the halts and the broader implications for market fairness. This legislative scrutiny highlighted the tension between retail empowerment and systemic risk. Would the hearings lead to concrete regulatory reforms? Even after the initial frenzy, volatility persisted. On February 24, GameStop's price doubled within a 90-minute window, demonstrating that the market remained highly reactive. Yet just weeks later, on March 24, the stock plunged 34% to $120.34, only to rebound dramatically the next day with a 53% surge. These sharp swings underscored the fragile equilibrium between supply, demand, and speculation. What underlying mechanisms drove such rapid reversals? Behind the scenes, seasoned investors had already placed bets on GameStop. In mid-2019, Michael Burry's Scion Asset Management acquired a 3.3% stake, while Ryan Cohen disclosed a 9% investment in August 2020 and later joined the board in January 2021, sparking an early rally. Their involvement lent credibility and attracted additional capital. How did these early moves intersect with the Reddit-driven surge? A key individual emerged from the Reddit community, Keith Gill, known online as Deep Fucking Value and Roaring Kitty. He purchased roughly $53,000 in call options on GameStop in 2019, a position that ballooned to a $48 million value by January 27, 2021. Gill's public posts amplified the narrative of a coming squeeze, turning him into a folk hero for many traders. What role did his visibility play in galvanizing the crowd? The frenzy was not limited to GameStop. Other heavily shorted securities and cryptocurrencies also surged, while AMC Theaters experienced a parallel squeeze triggered by the same Reddit community on January 27. The value of AMC networks rose significantly, illustrating the broader ripple effect across markets. How extensive was the contagion beyond the original target? Brokerage responses varied worldwide. While Robinhood halted purchases, platforms like Trading 212 in the UK and eToro in Israel blocked buys but allowed sales. Webull initially stopped buy orders before resuming them, citing increased collateral requirements from its clearinghouse as a limiting factor. These disparate actions highlighted differing regulatory environments and risk tolerances. What impact did these restrictions have on retail investors' ability to participate? Analysts later identified a gamma squeeze occurring alongside the short squeeze, amplifying the price surge as market makers hedged their exposure by buying the underlying stock. This dual mechanism, combined with unprecedented trading volumes over 175 million shares on January 25 alone, underscored the extraordinary market dynamics at play. Did this convergence of forces create a once-in-a-generation market event? In the aftermath, the narrative remains contested. While some attribute the surge to coordinated retail action, later analysis by a cybersecurity firm suggested thousands of automated bots may have amplified the hype. Yet the extent of bot influence remains unconfirmed, leaving a lingering question about the true drivers behind the frenzy. As the dust settles, the GameStop saga continues to provoke debate over market power, technology, and regulation. Returning to our opening mystery, the GameStop Short Squeeze demonstrated how a confluence of massive short interest, online community coordination, and platform interventions can reshape market dynamics. While the episode sparked hearings, lawsuits, and global regulatory scrutiny, the ultimate lesson endures: modern markets are vulnerable to rapid, collective action, whether human or algorithmic. The question now is how future safeguards will evolve to balance innovation with stability.